Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
In today's episode, you'll learn about, first, heading into today's open. A violent rotation rocks markets overnight as capital flees tech for energy and financials. With the Dow surging while the Nasdaq struggles, will this great decoupling accelerate at the bell, or is a tech rebound brewing? Second, crisis looms. US manufacturing plunges to a 14-month low, igniting stagflation alarm bells. As factory activity collapses, input prices are secretly skyrocketing, putting the Fed in an impossible position. With a potential $1 trillion Supreme Court bombshell on the horizon, will industrial stocks face a massacre at the bell? Finally, the $600 billion AI shock returns. A top analyst issues a stark warning as China reveals a new high-stakes strategy. A new research paper reveals China's secret plan to bypass US chip controls by focusing on efficiency, not power. Is this the opening shot in a new AI war? And could it trigger another tech bloodbath? A quiet revolution is happening right under our noses. While the headline indices show modest mixed results, a violent rotation is tearing through the capital markets, punishing the crowded trades of 2025 and aggressively bidding up the unloved sectors of the real economy. The divergence is stark. The Dow Jones Industrial Average surged over 600 points, driven by industrial and financial might, completely decoupling from the S&P 500, which finished flat, while the tech-heavy Nasdaq struggled to hold ground as smart money began a tactical retreat from mega-cap growth. This market behavior signals a critical pivot point for 2026. The catalyst was the stunning geopolitical development in Venezuela. The Trump administration's signal to revitalize the Venezuelan oil sector sent energy stocks soaring, with giants like Chevron and service providers like Schlumberger jumping between 5 and 9%. But here is the critical disconnect analysts are watching. Crude oil prices remain flat at $57 per barrel. Why represent such a massive divergence between equity prices and the underlying commodity? Analysts point out that this is a classic sentiment trade rather than a fundamental supply shift. The physical oil from Venezuela will take years and billions of dollars in infrastructure investment to hit the market. Investors are buying the policy optionality and the deregulation narrative, not the immediate cash flows. This suggests that the energy rally is a bet on the long-term strategic direction of the US administration, but it carries significant execution risk if the infrastructure build-out faces delays. This rotation extends beyond energy into the financial sector. ETFs tracking major banks and financial institutions saw significant inflows, with JP Morgan Chase and Goldman Sachs rallying sharply. The market is pricing in a Goldilocks scenario for banks where the yield curve steepens, meaning long-term rates stay higher while the Fed cuts short-term rates. This dynamic expands net interest margins for lenders. Furthermore, experts believe the regulatory environment is loosening, which could unlock a wave of merger and acquisition activity, directly benefiting the bottom lines of major investment banks. However, this rotation comes at the expense of the technology sector. The S&P 500 is currently trading at a forward price-to-earnings ratio of 22.4, a premium significantly above its 5 and 10-year averages, with earnings growth forecast to decelerate from 8.5% last quarter to 7.5% in the fourth quarter. The margin for error is non-existent. Analysts warn that capital is flowing out of high multiple technology stocks because the valuation math simply does not work if interest rates remain elevated. We are seeing cracks in the breadth of the technology sector. While Tesla and Amazon found buyers, Nvidia faced selling pressure, dropping nearly 1% despite strong AI fundamentals. Interestingly, Taiwan's semiconductor manufacturing company hit record highs, suggesting investors are moving away from the expensive US megacaps and looking further up the supply chain for value. This is a clear signal that the blanket buy the tech sector strategy is being replaced by highly selective positioning. The backdrop to this sector warfare is the Federal Reserve's policy transition. The market consensus currently anticipates 2 to 3 rate cuts in 2026. However, inflation remains sticky above the 2% target, and the labour market is showing signs of stress. This creates a policy dilemma. If the economy remains too hot, the Fed may pause cuts, crushing high valuation tech stocks. If the labour market cracks, we face a recessionary scenario. This brings us to the most critical data point of the week. All eyes are now fixed on Friday's employment report. Consensus estimates expect 55,000 new jobs with the unemployment rate hovering around 4.5%. This number will likely dictate the market's direction for the rest of the month. If the jobs number surprises to the upside, hitting 70,000 or more, it would signal economic resilience. While good for the economy, the market would likely interpret this as a signal that the Fed will keep rates higher for longer, putting renewed pressure on technology valuations and treasury yields. Conversely, a significant miss below 40,000 jobs would confirm labour market weakness, potentially accelerating rate cut expectations but raising fears of a hard landing. The easy money phase of simply buying the index appears to be over. The market has shifted from a tide that lifts all boats to a stock picker's environment defined by sector rotation, policy sensitivity, and valuation discipline. Friday's data will determine if this capital rotation accelerates or if the bulls can regain control of the narrative. Heading into today's open, a battle is brewing over the impact of tariffs on the US economy. New data shows President Trump's trade policies have driven the average tariff on imported goods to nearly 17%, and the fallout from the factory floor is getting louder. You might remember we discussed how a high-profile product failure exposed the risks of leaning on a single client. Well, that episode was already nudging companies to explore manufacturing hubs outside China. Today's elevated tariff backdrop is turning that slow drift into a shove. Many analysts are now arguing the tariff strategy is failing to boost US manufacturing. Instead, it's acting more like a direct tax on businesses, squeezing their profits and dragging down activity. And that brings us to the latest data. A critical report from the Institute for Supply Management reveals US manufacturing activity just slumped to a 14-month low. The sector has now been in contraction for 10 consecutive months, with the index falling to 47.9. A reading below 50 signals a shrinking factory economy. But this is where the situation takes a more complex turn. While factory activity is shrinking, the prices manufacturers are paying for raw materials are actually rising sharply. The ISM's prices paid index just jumped to 58.5. This combination of slowing growth and rising costs is a classic signal of stagflation in the goods sector, and it puts the Federal Reserve in an incredibly difficult position, forcing a choice between fighting inflation or supporting a weakening economy. But the real story is what businesses are saying on the ground. These are not analyst predictions. These are direct quotes from the front lines. One manufacturer of miscellaneous products reported that their 2025 revenue was down 17% specifically due to tariffs. Another in fabricated metals called December dismal, with future bookings down 25%. It's a grim picture, but that's not the whole picture. Actually, we're seeing a two-track manufacturing economy emerge. While traditional sectors like metals and transportation are getting hammered by these tariffs, other areas are booming. Think about AI-driven industries and advanced electronics. For example, some semiconductor equipment makers are projecting double-digit sales growth for 2025. This ties back to our conversation on that platform shift into AI wearables and next-gen devices. Even as core factory activity slumps, chip-centric niches are still showing strength, which is why semis can behave like an outlier. The warnings get even more stark. Transportation equipment makers are seeing new orders come in 20 to 30% below historical buying patterns, with one respondent stating the general mood of the industry is that the first half of 2026 will be another bust. This collapse in future orders has a direct and immediate consequence. First, companies are hitting the brakes on hiring. The ISM report showed factory employment has now been shrinking for 11 straight months, with comments about layoffs tripling those about hiring. This is a crucial signal because weakness in factory jobs often spreads to the broader services sector later on. Second, in the face of falling demand, companies are aggressively cutting their existing stockpiles. The ISM's inventories index just plunged to 45.2. While this destocking subtracts from economic growth in the short term, watch this number closely. The end of this inventory cutting cycle is a necessary first step before any future recovery in production can even begin. This isn't just a few isolated companies. The report shows a staggering 85% of the entire manufacturing economy's gross domestic product contracted last month. This all comes as the US Supreme Court is set to rule on the legality of the tariffs early this year, and the stakes for this Supreme Court decision could not be higher. If the court rules the tariffs were imposed illegally, the US government could be on the hook for refunding every dollar collected. Believe it or not, estimates for these potential refunds range from a staggering $750 billion to $1 trillion. This creates massive uncertainty for the market heading into the ruling. This grim outlook from the factory floor puts a spotlight on industrial and manufacturing stocks ahead of the bell as traders digest whether this pain is a temporary downturn or the start of a much deeper decline. So, as you watch the open, here are the key things to track. First, keep a close eye on industrial and manufacturing stocks, which you can track through an exchange-traded fund like the Industrial Select Sector SPDR Fund, ticker XLI. They are likely to face pressure. Second, watch for that divergence we talked about. Will traditional manufacturing stocks suffer while high-tech names, like those in a semiconductor ETF such as SMH, hold up? This will tell us if investors are betting on that two-track economy. We've also flagged AAPL and Meta before as bellwethers for that AI hardware pivot. Their performance can help confirm if the market keeps rewarding the chip-heavy side of this story. And for investors watching China's A-share market, we previously pointed to suppliers like Luxshare Precision as a stress test for concentrated customer risk. Finally, this data increases the risk of a policy mistake from the Fed, so watch the 10-year Treasury yield for any signs of shifting interest rate expectations. Speaking of the divergence between traditional manufacturing and high tech, let's zoom in on the heart of that tech world, where a ghost of market panic is haunting the AI sector. Almost a year ago, a little-known Chinese lab called DeepSeek released an AI model so powerful it vaporized nearly $600 billion from NVIDIA's market cap practically overnight. The model triggered a global tech sell-off, with chipmaker Broadcom also plunging 17%. The fear was that China had suddenly leapfrogged the US in AI, directly challenging the premise of American dominance and threatening the entire revenue narrative for companies selling high-end chips. Interestingly enough, this extreme, though short-lived, reaction revealed what analysts now call an AI shock premium hidden in tech stock valuations. So the thing is, the market is incredibly sensitive to any perceived threat to American tech leadership. This creates a new kind of risk for investors where geopolitical surprises in AI can cause massive, rapid sell-offs, even if a company's immediate earnings aren't affected. This connects to another pressure point we flagged before. The AI boom itself can be a hidden threat, stoking inflation via a massive data center build-out and rising chip costs fuel that keeps the fear gauge jumpy when leadership is questioned. Heading into the open, watch for any unusual spikes in the CBOE, Volatility Index, or VIX, often called the market's fear gauge, as a sign of this underlying anxiety. But that shockwave never repeated. In fact, NVIDIA recovered and went on to become the first company ever to hit a $5 trillion valuation. As we've noted, the AI build-out has effectively become a primary engine of US demand, even as it strains power grids and ends the era of ever cheaper compute, which helps explain why that rebound had real endurance. The powerful recovery is rooted in a concept investors must understand: the AI capex supercycle. This isn't a passing wave. After all, the demand for high-end chips is less about the efficiency of any single frontier AI model and more about the sheer volume of AI being deployed everywhere. Hyperscalers like Amazon, Google, and Microsoft are in an arms race, with their combined spending on AI infrastructure projected to exceed $600 billion. You'll recall our discussion on how data center electricity demand is set to surge by the end of the decade, and how chip prices have been firming structural forces that keep budgets expanding, even when model narratives wobble. This massive, sustained investment underpins the valuations of semiconductor firms, making them more resilient to software-side shocks than initially feared. So what happened to DeepSeek? The situation presents a fascinating duality. On one side, China's ambition, while on the other, it exposes a hard constraint. Resources, China's effort to counter the US private sector build-out ran into a wall. Now get this. These restrictions have created what experts call a compute ceiling. And this isn't an accident. It's a deliberate US strategy to slow China's progress. The performance gap is real. For example, even China's best domestic alternative, Huawei's Ascend 910C chip, is estimated to deliver only about 60% of the performance of NVIDIA's top-tier H100 chip. This hardware gap is the main reason the initial panic faded. One report noted the company faced challenges training its next model on homegrown processors after being encouraged to reduce reliance on US alternatives. While DeepSeek struggled, US giants like OpenAI and Google released their own new powerful models, reassuring investors and easing fears. The market has regained its confidence in American AI leadership. But heading into today's session, the story takes another turn. DeepSeek just published a new research paper detailing more efficient AI development, and one of Wall Street's most watched tech analysts, Dan Ives of Wedbush Securities, is issuing a stark warning for the year ahead, saying, quote, "There'll be another DeepSeek." The bottom line for today's session is this: that new research paper isn't just an academic exercise. It points to a major strategic pivot. It suggests a new axis of AI competition is emerging, one focused on algorithmic efficiency rather than just brute force computing power. If you can't get the most powerful chips, you write smarter software to do more with less. And remember, the CapEx wave and power constraints aren't going away. Data centers are set to demand far more electricity, so an efficiency race could shift, not squash, the spending and keep those inflation pressures alive. This is a strategy to bypass the compute ceiling and could undermine the long-term effectiveness of US chip controls. This is the new dynamic to watch. At the open, look for any divergence in performance between AI hardware stocks, tracked by ETFs like the iShares Semiconductor ETF, SOX, and AI software companies. As the market digests this new strategic battleground.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.